Welcome to the Capital News. I'm your host, Alex Kreitis. Today is July 12th, 2019. So, record day on Wall Street, again on the back of the comments from Chairman of the Federal Reserve, Jerome Powell, his testimony before Congress earlier this week, all but saying that the Federal Reserve will be cutting interest rates at the end of this month. This will be on their meetings, the FOMC meetings, that will take place on July 30th and 31st. We will know of their decision on the 31st. Markets are anticipating, at a minimum, a 25 basis point cut. Depending on what news transpires between now and then, it might go up to 50 basis points. It might be 50 basis points now without any other news. So we are probably going to be in a period through the remainder of July with any bad news once again serving as good news as far as the markets are concerned. Because the worse earnings are, some sort of breakdown between U.S. and China trade talks, any other slippage with other underlying economic figures, we will have a reading of the initial print for Q2 GDP. This will come out before the Federal Reserve meets at the end of the month. So we're going to have a number of data points, and then obviously there's a whole bunch of one-offs of things that could come out of the woodwork that will serve potentially as negative news. And again, bad news will serve as good news for the remainder of this month. No doubt about it. This is what is propelling the markets. This is lunacy. This is why I say constantly that this is the financial road of Oz, because bad news is good news. That's not supposed to be how it works. The Federal Reserve is not supposed to come to the rescue every time Wall Street throws a hissy fit. That's exactly what they're doing. They're showing you their cards. They're showing you their hand, who they really work for. They don't work for the American people. You have Jerome Powell up there all the time saying, well, it's for the betterment of the American people. I'm concerned for the American people. Well, what American people, sir? I wrote an article on this. You can check it out on the Capital News a few months ago. What Americans are you talking about? Because you're most definitely not talking about senior citizens who live on a fixed income. You're most definitely not talking about individuals who are trying to save and earn some money in a savings account. I mean, there's no other way to put it. You're screwing over these people hand over fist. You're rewarding bad behavior. You're pushing people further and further out onto the risk curve, which quite literally means they're going to make bigger risks than they otherwise would have made in the absence of this cheap and available funny money. What are the malinvestments? What are the distortions? This all has negative implications and consequences that will come home to roost. This is what happens. They are trying to kick the can further and further down the road. And unfortunately, we also have an administration who is calling on the Federal Reserve to kick the can further down the road. Not to solve it, but to kick the can further down the road. Lower interest rates, and that's not enough. Embark on quantitative easing, another round of monetizing the debt. At a time, mind you, that the same administration tells us that this is the best economy in U.S. history, which of course is not true. You can't have it both ways. But most Americans have no idea what that means. This is the best economy, lower interest rates, quantitative easing. Sure, that makes sense. It doesn't. And this is a true travesty. This is a major disservice to the American people because, again, the president is in a unique position, given his position as the president of the United States, given his nature, his characteristics, his ability to get in front of a camera. He has the ability to educate this country on what the Federal Reserve is, what it does, how it's manipulated the markets, how it's caused bubbles, how it's caused distortions in the economy and the stock market. You know, the things he used to say when he was a citizen, when he was a candidate. Now he's president. Oh no, we can't have this go down on my watch. So kick the can down the road, cut interest rates, screw all these people over, including my base, by the way, but they don't know what's going on. So continue with that and go ahead and do another round of quantitative easing while you're at it. This is lunacy, but this is where we are. It's a true travesty. The S&P gained 14 points, closing at a record high. The Dow gained 244 points, representing a near 1% gain for the day. well north of 27,000. The NASDAQ gained 48. The Russell 2000 gained 12 points, an increase of 0.8%. The Dow Jones Transports really rallied, gaining 250 points for the day, representing 2.4% increase. So that made a quick liar out of me, folks. Yesterday I was talking about the divergence that existed between the S&P 500 and the Dow Jones Transports, something that we have not witnessed over the course of 18 months to this degree, if not longer. And I said, well, if the Dow Jones Transports is going to continue serving as a leading indicator, which historically it has, then the convergence will be the S&P going down to meet the Dow Jones Transports. Of course, that doesn't seem to be the case, but one day does not make a trend. But 2.4% increase for the day is a huge rally on that indice. The New York Stock Exchange gained 0.3%. And then just to throw it out there, since we've been talking about them over the past few days, Deutsche Bank gained 2.5% for the day and is now trading at $7.67 per share. Oil, relatively flat for the day, but still with a 60 handle. WTI is trading at $60.43. Brent crude is now trading at $67.90. Now, we also have some weather concerns here down south over the Gulf. Will this mess with the refineries? Will this mess with any type of rigs that are out in the Gulf of Mexico? Time will tell. They will use it as an excuse. I know I've seen gas prices go up, I think over a dime here in western PA. So I'm sure that's true across the country. So we're going to have to keep our eye on this. We're most likely going to see an increase in gas prices over the next couple of weeks, especially if these storms persist. Gold is trading at $1,418 an ounce. Silver is at $15.25 an ounce. Uncle Sam's 10-year Treasury was down slightly. It is now yielding 2.11%. And the VIX, the volatility index, lost another 4% for the day, now sitting at $12.39. A couple topics that I want to talk about today include a follow-up to yesterday's podcast where we were going over the federal funds rate and how I was saying that it takes, in my opinion and my analysis, a lower interest rate to pop an ever larger bubble. So we're going to talk about that. I said there was a study that was conducted by the Federal Reserve, some economists within the Federal Reserve, one of the banks, that said with their quantitative tightening, not quantitative easing, but with quantitative tightening, that serves in and of itself as a rate hike. It's an implicit rate hike. It's not going to show up in the data on the federal funds rate. But if you conduct the analysis that they did, and this makes sense to me, because if you're going to throw liquidity out there like they did with quantitative easing, and now you're going to pull it back in with quantitative tightening, it makes logical sense that there is going to be some sort of tightening effect, some sort of increasing effect on interest rates. So it's not explicitly shown on the chart if you're going to look at the federal funds rate, but if you believe this study, and I believe it to at least some extent, that it is going to have some implications. It is going to have an effect when it comes to tightening of interest rates. So we're going to get to that. But first, I want to talk about some news with United States versus China. And of course, I'm talking about the trade war, because there was an interesting tweet the other day. It was either yesterday or earlier today. I don't know. There's so many tweets from the president. But it had to do with the president praising Mexico on doing a great job on their southern border and on ours, keeping illegal immigrants out, holding up their end of the bargain. Of course, we still don't know what the secret deal is. Remember when the president pulled out that piece of paper in front of the media there on the lawn of the White House saying, look, I got a secret deal here. I mean, we still don't know the details of that, but nevertheless, there it is. But he's praising Mexico for holding up their end of the bargain. However, he was sort of calling China to the floor to say, hey, Mexico's doing a great job, but China, you said you were going to buy a whole bunch of U.S. agricultural products. What are you doing? I don't see you buying them. Well, now you have China responding, at least these are the reports out there, and China's saying, no, we never made that promise. This is exactly what we have been talking about here on the Kapital News for weeks, if not months. This is the heart of my letter to the president that was written already back in May. Check it out on thecapitalnews.com. The heart of it had to do with the credibility of the president, and it was surrounding this: the negotiations, or lack thereof, between the United States and China on this supposed trade deal. I said this was going to happen, or I definitely warned that it could happen, and right now it is. And what am I talking about? I'm saying, well, on one side, our side, the U.S. side, you have the president and his administration coming out for several months saying a deal is going to be made, saying it's going to be fantastic, there's going to be signing ceremonies, everything's going to go fine. It's going to be a great thing, the best thing ever. Didn't happen. Talks fall apart. We blame the Chinese blame us. Then Donald Trump blames himself, basically. Said, I broke the deal. I broke it. It's me. I held it up. I'm holding the deal up. I can do what I want. Okay? All right, we'll run with it. It's your fault. It's their fault. Now it's your fault. Okay, whatever. There's escalation. We increase tariffs. They increase tariffs. Now there's a truce. Supposedly, this truce was predicated on China agreeing to buy more agricultural products from the United States. It was also predicated on the United States lifting a ban, or at least a partial ban, on Huawei. They're the national security threat, mind you. But China came to the table and said, look, we don't like that you said that Huawei is a national security threat to the United States of America. And if you want a truce, you're going to have to start selling to Huawei again. Oh, okay. Oh, yeah. We'll lift it. We'll lift it partially. Yeah, not a problem. And we'll tell everybody that we're going to continue to sell to Huawei a whole bunch of parts and other technologies that are readily available around the world. Okay. It's a national security threat. China says you got to sell to us. Oh, okay. We'll sell to you. I mean, this is not great negotiation, if you ask me. Just not. I mean, there was 3 points that China put on the table, at least from reports that we're told. Huawei, all tariffs need to be removed, and you, the United States, are not going to dictate to us, China, how many goods we have to buy from the United States. It's not going to be a set limit that you give us. It's going to be predicated on demand. Now, the other two you could have worked with. Maybe you could have temporarily cut tariffs. Maybe you could have said, I will put them off for a certain amount of time. Or maybe you just could have agreed to the last point and say, well, that makes sense. It's going to be demand-driven. I mean, you don't magically sign a trade deal and all of a sudden everybody's richer. The money just comes out of the woodwork. It doesn't happen like that. So say, okay, all right, well, that makes sense. It's going to be demand-driven, but please try to give preference to the U.S. or something like that. Okay. The one that they cave in on, that we cave in on, is the one that we're told is a national security threat. But now what we're talking about is, even in this deal, what caused this truce, what allowed this truce to exist for the time being, is that Donald Trump and company were under the impression that the Chinese were going to buy more U.S. agricultural products. Now you have the Chinese saying, no, we never promised that. I mean, that was brought up, but it was nothing that we promised. I have no idea who to believe. This is the exact problem I was talking about. And that's the other point. It almost makes no difference, unfortunately, because we're not going to know. Because Donald Trump and company are always going to say that this is the best thing ever. Of course, now nobody's in a hurry. That really means China's in no hurry. And they never were. The first round of negotiations, there was a 90-day deadline. So there had to be some maneuvering. Now there's no deadline. Now it's completely open-ended. Nobody's in a rush. Okay, we'll see what happens. This is a lot more to do with than just trade. You guys know this. This is a cover story. This is us, the United States, a superpower, trying to slow down an up-and-coming superpower. Economically, militarily, technologically, everything. It's what this is about. It's not about soybeans. Would it be nice for U.S. farmers to sell more soybeans? Absolutely. Absolutely. I don't want to see farmers go out of business. Although that's what we're seeing, unfortunately, particularly in the Midwest. But and now you have Donald Trump, who complains about a whole bunch of other countries subsidizing industries within their respective countries. Well, guess what we're doing here with a lot of our respective industries. Oh, yeah, that's right. We're subsidizing them. We're bailing out these farmers. I thought we were told that tariffs were a winning strategy, that it's easy to win these trade wars. Doesn't seem to be the case, does it? And now we have to bail out the farmers. It just doesn't make a whole lot of sense. But again, this goes to the question of credibility. You got two sides. We're saying one thing, and now the Chinese are coming out and saying, no, that's not true. That's not what we said. That's not what we said. That's not what we're going to do. You're not going to dictate to us what products we're going to buy and what quantity. So now this becomes interesting because, in effect, what the Chinese are doing, if this was a point that the United States believes was part of establishing a trade truce, and the Chinese are not following through with it, well then, what are the Chinese doing? They're calling Donald Trump's bluff. Now it's up to Donnie Boy to say, I ain't bluffing. And if he ain't bluffing, he's going to have to increase tariffs. Is he going to do it? Very interesting question, isn't it? The other thing that's going to be is bad news. But what does bad news mean? It means good news, because now the Federal Reserve is going to come with an even deeper interest rate cut. What a game. What a game that's being played. This is disgusting. If this was just a game that only affected a few people, I wouldn't care. I couldn't care less. But this affects everybody. It affects everybody. And that's the problem. That I have a conscience. I care about people and what this is going to do to people. People who have been working hard in saving or attempting to save for 30, 40 years of their lives, to have a lot of it wiped out overnight potentially. Now, of course, overnight, a couple months, several months over time. But by the time you get, the big crashes always happen quickly over the course of a couple months. And unless you know what's going on, to get out, you're basically trapped. You're done. So that entire life savings is pretty much halved. Is that enough? No, it isn't. We talk about the numbers every day, all the time here. Most people do not have enough money saved for retirement. You have a terrible demographics cliff. You have terrible underfunded pensions throughout the entirety of the United States. You're going to have people retiring with their 401ks, IRAs, who are going to be pretty much forced to make withdrawals from those accounts. So that's going to be a net outflow from the stock market. This is not setting up as a pretty picture. Not at all. But that's what I wanted to call out because, again, here we are. The United States says something, and now China's coming out and contradicting. What do we believe? And then in other news, real briefly here with China is warning the United States, do not meddle with Taiwan, because supposedly the United States is set to sell some tanks and other military equipment to Taiwan. Of course, China thinks Taiwan is their territory. We have treaties and obligations to defend Taiwan. It's a whole bunch of ridiculousness, but this is just something else that's going to stir the pot, so something else to pay attention to. Now, getting back to our discussion yesterday in regards to quantitative tightening and how it may have another effect of actually increasing interest rates, we're going to talk about this too. Just as a recap from yesterday, if you look back the past few recessions, early 90s, 2000, and most recently 08-09, if you go back to the early 1990s, you had a Fed funds rate right before the recession of over 9%. Okay? The Federal Reserve increases interest rates, pricks the bubble. You have a recession in the early 90s. Continue through what's called the Great Moderation of the 90s. You then have a federal funds rate that peaks a little over 6%. Federal Reserve pricks the bubble. In recession we go. Then you have lower interest rates for a long time, which causes the subprime crisis, the financial crisis, the Great Recession. You have interest rates then at a little north of 5%. So you go 9%, down to north of 6, down to north of 5. Now we sit at 2.25%, 2.5% on the federal funds rate. However, if you take into consideration the effects of quantitative tightening as well, it's probably actually a little higher than that. So this has been a bigger pricking of this bubble. It's already been done. The horse is out of the barn. He ain't coming back. Okay? But here's a brief article from the Council of Foreign Relations. Talk about deep state. Talk about military-industrial complex. But nevertheless, allow me to read a couple paragraphs from this article. Before the 2008 collapse of Lehman Brothers, the Fed's balance sheet stood at $925 billion, mostly U.S. Treasury securities. After 59 months of asset purchases, quantitative easing, to push down longer-term interest rates, it had ballooned to a peak of $4.5 trillion, including nearly $1.8 trillion in mortgage securities in 2014. So they bought a lot of junk from banks, all these mortgage-backed securities and a whole bunch of bad mortgages. The Federal Reserve bought them. Okay, they continue. In October of 2017, the Fed at last began a slow slimming down of its balance sheet, allowing a growing amount of maturing securities to roll off monthly without reinvesting the proceeds. In former Fed Chair Janet Yellen's words, the central bank did, quote, not have any experience in calibrating the pace and composition of asset redemptions and sales to actual prospective economic conditions. Layman terms, the Federal Reserve doesn't know what the hell they're doing. We've never done this before. We've never been at the zero bound for this long. We've never embarked on quantitative easing this long, to this degree, ever. We have no idea what's going to happen. That's what she's saying. She's just using bigger, fancier words to talk about it. No idea. None. So it continues, yada, yada, yada. But the thing that I want to talk about has to do with this. Now they continue and they say, our calculations also suggest these balance sheet effects will soon get larger. If asset runoffs continue at the Fed's announced pace of $50 billion per month, then by the end of 2019, they will tighten monetary conditions as much as a policy rate increase of 220 basis points, or 2.2 percentage points. Okay, and then they reference one of their graphs in the article. It continues and concludes, what are the implications for the U.S. economy? The Fed estimates that once interest rates surpass 3%, their, quote, neutral level, monetary policy will shift from stimulating economic growth to constricting it. Today, the Fed expects that rates will remain below this neutral level until the end of 2019. But by our calculations, the combined effects of balance sheet reduction and conventional rate hikes will produce an equivalent tightening in monetary conditions much sooner, by the end of 2018. This article was written in November of 2018. This fact suggests that monetary policy will start to contract economic growth early next year. Boom. Exactly what we have been talking about, predicting here, and all of the underlying economic news that we talk about here on a daily basis is pointing to contracting economic growth. It's just the fact of the matter, folks. And now you have basically an implicit federal funds rate that would be about north of 3%. No question about it. And of course, this was written in November. This is when the Federal Reserve was still, we're in a hiking mode here. This is a hiking cycle, and that's what they did. They did increase interest rates in December in their December meeting. We know what happened. We had the 10% correction. We had the 20% bear market by Wall Street's technical terms. Wall Street threw their hissy fit. Jay Powell comes out and does a 180. Oh, my bad. Didn't mean to do that. We'll do wait and see. And we've been in wait and see mode for the past 7 months. We've had jawboning, and now you've had bad news is good news. We've had that several times over throughout early winter, spring, and now we're in the summer. Bad news is good news. Sometimes good news was good news, but now we're back on the cycle of bad news is good news because the Federal Reserve is set to cut interest rates at the end of this month. The question remains, to what degree? Makes no difference. These are policy tools. It's not a light switch. You don't flip it and boom, the lights are on. This takes time to make its way throughout the economy, just like conversely, quantitative tightening and an increase in interest rates takes time. It is continuing to make its way through the economy. This is why we are seeing a slowdown. These are the effects. It's not just because of the interest rate hikes. This is because people in corporations and governments are oversaturated with debt. They are tapped out. You can give it to them. You can say, look, it's here. This is like leading a horse to water. Can't make them drink it. No, I got enough debt as it is. I'm stretched out. I got 2 credit cards. They're maxed out. I don't want to take another one. I'm paying 25% interest on minimum payments just to make ends meet. I got to work 2 jobs, 3 jobs, in supposedly what's supposed to be the greatest economy ever in the history of the United States. Yet you have people tapped out. Just doesn't jive, does it? Not at all. So this is all kicking the can down the road. This is all masking everything. We have basically a federal funds rate north of 3%. I think where it stands today, just where it actually does say we are, 2.25%, 2.5% was enough to prick the bubble. But implicitly, with what has taken place with the rate hiking cycle, plus quantitative tightening, which is expected to continue unless the Federal Reserve changes course at the end of this month, that is supposed to continue until the end of September. But again, they might change course on that as well this month. We're going to have to wait and see. But let's assume that quantitative tightening continues for the course of the next 2 or 3 months. That's going to basically have a counteracting effect on any interest rate cut that they do now. So it's going to be very interesting to see what they believe, because while I was reading an article from the Council on Foreign Relations, that was a study done by the Federal Reserve. So somebody must have said somewhere, Janet Yellen's comments, we don't know what we're doing. Maybe somebody should look into this. Maybe somebody at the Federal Reserve does have a brain to at least ask a question. Maybe quantitative tightening does have some more restrictive effects than what we are predicting. Maybe because basically the Federal Reserve was treating these 2 things, these 2 tools, quantitative tightening and interest rate policy, as being mutually exclusive, that there was no overlap, that they weren't going to act in tandem. Now that's ridiculous, as it comes out of my mouth, that they could even think that these things were mutually exclusive. But evidently, Janet Yellen had no idea what was going to happen. She's gone. She's responsible for a lot of this, as is Ben Bernanke. Yet they wiped their hands clean. They both claim that there's not going to be another financial crisis or any type of big downturn in their lifetime. This is what they say. This is the arrogance and stupidity of these people. They've destroyed this country. Most people don't even know who they are. But we do. And we're going to hold them to account. Because this is getting ridiculous. You're trying to save money. You're on a fixed income. They don't care about you. They care about Wall Street throwing a hissy fit. So we're going to keep our eye on this. We're going to pay attention. This is going to be a very interesting month, folks. Remember, next week is really going to be the kickoff of earnings season. So if they have good news, the market will love it. That'll be somewhat good news, obviously. If it's bad news, the market's going to love that too, because it's going to say, well, maybe the Federal Reserve will cut interest rates even deeper. We could be in a melt-up mode. History says it can happen, but look out below once that runs its course. So today is Friday. Enjoy your weekend, everybody, and I will catch you back here next week, unless I feel like doing something over the weekend, which could happen because we never know what's going to transpire. But enjoy your weekend. Thank you so much for joining me. This is the Kapital News. I am Alex Kouraitis. Godspeed.